Good morning, melon heads. It is Friday the 13th of 2023, and that is only fitting because right now, pre-market, everything looks like a horror show today. Bank earnings are coming in, and as I suspected earlier this week, loan loss provisions appear to be dominating the story with bank earnings, although net interest income did look very good for most of the banks. Net interest income is the difference between the cost of banks to borrow money versus how much income they make when they lend it out. And that was way up for most of the banks today, all except Wells Fargo. Of course, they're taking a hit from some settlement costs because of their never ending legal issues. But the big one was the loan loss provisions. You see, the banks, they know when you stop swiping your card at the store, or when you stop clicking add to cart, or when you stop paying your bills. The banks are the first ones to know about it. They're the first ones to see the trend. And right now, they're telling us that trend is gaining steam because they're all setting aside money to make up for it. So with that, we are going to shrink my big melon of a head. Grab your wake up juice and let's go through the indexes right now. Looks like the S&P has opened up down 0.68% or about 27 points at 39.56. The Dow is currently down 115. It was down a lot more than that pre-market, or 0.34%, hovering around 34,000. And the NASDAQ is down 79 points or 0.72%, about 10,921. So stocks down a little bit, but it looks like they're clawing back a little bit that after the opening bell. Looking at commodities right now, gold is up a tick, still just over 1,900 at 1,905, up $7 or 0.37%. Silver is back below $24 at $23.95, down a nickel. Nothing too big there. Looks like we've got the base metals are negative a little bit for the day. WTI crude is up 64 cents at $79. Energy is starting to look better, folks. Keep an eye on that one, especially in light of the Chinese reopening and, of course, the end of the dumping of the Strategic Petroleum Reserve. I think we'll be hearing more about energy in the weeks to come. Looking at the U.S. dollar index, it is up about a quarter today of 1% at 102.5 after that big slide yesterday. And the decline of the U.S. dollar index towards that 100 level continues. Let's look at a one-day chart here. Looks like it's looking about flat for the day so far. Over in the bond market, looks like we've got yields are up across the board with the exception of the 6-month, which is the high point in the yield curve right now. Check out the difference between the 1-month and the 10-year yield. Almost 100 basis points or a full 1% difference between the 1-month Treasury and the 10-year Treasury. You can get a percent interest more to loan your money to the government for a month than you can if you lock it up for 10 years. But I'm sure everything is just fine over there at the government. All right, let's take a look at the 10-year Treasury yield. And this is going all the way back to the end of 2021. And this is a big chart here, folks, because we've been watching right now this ascending level of support that started really all the way back on January 1st of 2022. But look right here where I'm hovering right now. We have got a big breakdown in the 10-year yield. We broke down below this level. Let's zoom in. We broke down below. We came back up, retested, came back down. We even hovered around it for a little while yesterday. This is kind of scary here. This is telling me that yields are heading lower, and it may be time to retire this ascending level of support because starting on January 1st of this year, or I think it was on the 3rd, was the first trading day, yields have started grinding lower, and they haven't stopped since the start of 2023. So is that going to be the story of 2023, the recession fears? Because that's what this is. The Fed is still raising rates. The short end of the yield curve, the shorter duration bonds, they're still going up. The interest rates on those are still going up, and yet the interest rates are going down on the long end of the curve. That is a flight to safety that's happening. That is recession fears. People are buying the long duration government bonds, bidding up the prices of those bonds and sending the yields lower. So that's an important trend to keep an eye on because that is a recession fears trend. And why the fear of the recession? Well, take a look at this. Shout out to Zero Hedge. It's a little blurry, but every line on this chart, every bar is a monthly snapshot of the change in people's real incomes. Real incomes meaning your earnings adjusted for inflation. We are looking here at 21 consecutive months of negative real earnings for Americans. For the last 21 months, almost 2 years straight, the rate of inflation has been higher than the rate of your earnings going up. Look at all of these red bars here. This has been, economically speaking, the worst period going all the way back to 2008. All right. Now, we haven't had the asset price deflation we had in 2008. Everybody's homes didn't drop in value by tremendous amounts. I'm talking about your income, the amount you bring in at the end of the month. It has gone down relative to the cost of living for 21 consecutive months. It has never been so bad. All right. So while we're hearing about, oh, it's strong as hell and all this stuff and, oh, my economic plan, all that nonsense. Nope, folks, we are getting poorer at a rate we have never seen in this country right now. And that is thanks to the increase in inflation and then the Federal Reserve doing everything in their power to make sure you and I don't get a raise. So with that in mind, let's take a look at the bank earnings right now, because that is what is worrying everybody. Right now, JP Morgan tops estimates for the fourth quarter. Oh, it sounds very good. Their net interest margin was up. They're loaning money for more money than they're paying, obviously. But here is the big one, and you got to scroll down right here. The bank posted a $2.3 billion provision for credit losses in the quarter, a 49% increase from the third quarter that exceeded the $1.96 trillion that the street account was estimating. So JP Morgan is setting aside $2.3 billion just in case you don't pay your bills or you don't pay your credit card or you default on your mortgage. That is a huge amount of money that's coming right out of their earnings. That is the world's biggest bank telling us there is bad stuff on the horizon. And JP Morgan stock is behaving accordingly, down 1.86% right now. Looking over at Bank of America, we got something similar right now. Again, their net interest income looked pretty good, but highlighted right here, Bank of America increased provisions for credit losses to $1.09 billion in the fourth quarter, following an $898 million in the previous 3 months. Again, the banks are getting ready for credit losses. They're getting ready for defaults. Why? Because they see this. They see that the cost of living has risen faster than the earnings, and therefore people are not going to be able to pay their bills. And I'm not going to show that credit card chart again because I've been showing it over and over again for the last few weeks, but Americans are putting life on the card. They can't afford it, and the banks are getting ready for defaults on those loans. Checking over here, Bank of America stock currently down 62 cents or 1.8%. Wells Fargo stock, same thing, although Wells Fargo is just the worst bank in the world. They're still dealing with fallout costs from all of their various scandals, so their earnings weren't that good, but they also had this one. In the latest period, the bank set aside $957 million for credit losses after reducing its provisions by $452. That should be an M for million a year ago. So all the big banks setting aside money for people not paying their bills. And we look here at Wells Fargo stock. They're down almost 5% pre-market. So things are just not looking too good for the banks right now. There goes my timer. That is my 2-minute warning. Silence timer. So long story short, folks, stocks are down right now because the bank earnings were, despite the headline numbers looking pretty good, it's those loan loss provisions. That's what's driving things right now. Now, there's a couple of charts I want to show you guys right now. First of all, this is the VIX, the volatility index. This is really derived from options pricing, and this is going all the way back to 2016. We have had this long-term trend of increasing volatility. It started in the really late 2017, early 2018. We had some big spikes, but we also had this increasing level in the bottoms. These are monthly snapshots. We're actually getting pretty close to that support. Volatility right now is much, much lower than it's been for a long time. It's approaching that level where it could bounce. We'll see if that carries out. Another thing I want to point out is that Bitcoin right now running pretty hard, pushing 19,000. But take a look at the RSI in Bitcoin, about 81. Yeah, that is overbought, to put it mildly. And we're also approaching the 200-day moving average. There's a lot going on in the crypto world. So Bitcoin is due to take a breather. There's no shortage of scandals that are still going on in crypto. We had the SEC came out yesterday and announced that they are going to be charging Genesis and Gemini with selling unregistered securities. I'm sure that's going to cause something. Remember, Genesis is owned by the same company, Digital Currency Group, which owns the Grayscale Bitcoin Trust. That could cause big problems. All right, guys, we are going to wrap it up there. I want to say hi, Mom, hi, Dad. I love you guys, and send a shout-out. Thank you to my Patreon supporters for everything you guys do to support the channel. Link down below should you feel so inclined. And until next time, live small and dream big.